morning everyone, this is Amit Pabari, founder and managing director of CR Forex. In financial market, one asset class will always have an impact on other asset class. In today's presentation, we are going to understand how metal market is going to impact dollar index and what impact it is going to have on our currency rupee. As discussed in last week's presentation, that gold has given a breakout and it is likely to move towards higher level. Generally, there is some kind of positive correlation between gold and other metals. Now let us understand what is happening in other metals also. Now let me start first with silver. On a daily, weekly and monthly chart, silver has given a clear-cut breakout, and on a quarterly chart, it is yet to give a breakout. If that breakouts come, silver prices are going to move higher because of two reasons. Production level is on a lower side and industrial demand has picked up. Gold and silver both have given breakout. Now let us see what is happening in copper and nickel. If you see copper chart, it has also given a breakout. Apart from that, it has given a golden crossover, which means that whenever 50-day moving average is crossing 200-day moving average on a daily chart, prices are supposed to move higher. Fundamentally also, we have understood that China government has given a lot of stimulus packages in last 6 to 8 months, which is going to boost housing demand in China in coming days. If that happens, copper demand is going to go higher. Apart from that, production level, because of production in Africa is facing some kind of issue, production has come down. So there is a double kind of a logical reason why copper is going to move higher. Nickel का भी story same to same है. The demand is going to increase because of increase used in EV batteries and production is at lower levels. अब आते हैं मेन पॉइंट पे. In the longer frame of time, there is a negative correlation between commodities and dollar index. If you see the chart, you can understand that. At current point of time, most of the commodities like gold, silver, nickel, they have given a breakout. Dollar index is yet to give a breakdown, but we are very sure that in coming days, dollar index is also giving a breakdown at the lower level, and dollar index is gradually moving towards 100 levels in 2024 and below that in early 2025. If that happens, it is positive for all emerging market currencies. Now let us discuss outlook for rupee. In coming days, we have 3 central banks meeting: Fed, ECB and Bank of England. The entire market is expecting that in the March meeting they are not going to cut the interest rate that is already discounted by the market. But the important aspect of the meeting is to understand when they are going to cut interest rate and by what percentage they are going to decrease the interest rate in the year 2024. The central bank which is going to cut the highest percentage of interest rate, their currency is going to get weaker. Logic क्या है उसका? Logic is very simple. If you increase the supply of any currency by decreasing the interest rate, then supply gets higher and value gets lower. And we expect Fed to cut more interest rate than others. Therefore, we are expecting dollar index to move lower and it will be positive for all emerging market currencies, including rupee. In case it goes other way around and dollar index shoots up and rupee move towards 83 kind of a level, that level should use by exporter to increase their hedge ratio and importers should not panic. Now let us conclude the view. 82.90 and 83.05 is going to act as a very, very strong resistance for the pair, and gradually the pair is going to move towards 82.5, 82.20 and 82. Now let us discuss strategy for thin margin exporters like chemical exporters and agri exporters. Most of them are taking costing close to 82.6 82.75. We will suggest them between 82.80 से लेके 82.95. They should cover 100% on a back-to-back basis. If someone wants to wait, they should keep a strict stop loss of 82.70. We still suggest all thin margin exporters that they can overhedge 5% of their annual turnover close to 83 kind of levels. Now let us discuss strategy for thick margin exporters like textile, engineering or pharma exporters. If someone is hedging under anticipation basis, they should keep a hedge ratio between 65 to 70%. If someone is booking based on confirmed order basis, they should keep a hedge ratio of 85 to 90%. In order to maintain that hedge ratio, they can sell between 82.85 से लेके 83 के बीच में. Now let us discuss strategy for importers. Near 82.70, we will suggest importers to only cover 50% of their imports payable which are due in next 15 days. For rest of the import payment, they can keep a stop loss of 83.10 and wait. With this, I will end my today's presentation. जय हिंद, नमस्कार, फिर मिलेंगे next week. Thank you.